Well, hello. I'm Nicholas Bohnsack, President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. It's very good to be back with you again this week, though it seems that we're now firmly in the grip of fall. And with the notable change of the weather, we have yet another reminder of the gnawing persistence of COVID-19 and the challenges we face in punching through it and recovering from it. The societal impacts remain acute. We're reminded that many of our neighbors have experienced great loss during this pandemic, while others, whether they've had the virus or not, have come away ostensibly unscathed. And so it was notable when the president himself tested positive. And while we're happy to hear he's on the mend, it's interesting that we've heard less about the First Lady. While his health has improved, POTUS has not been entirely unscathed, however. As we know, the last few weeks have not been kind to the president or his prospects for re-election. Irrespective of your personal politics, as an investor, these machinations matter. There appears little doubt that political volatility will dominate the headlines over the next several weeks. To read the polls alone is to believe that Joe Biden has opened an insurmountable lead over Donald Trump, and that the slugfest for control of the Senate has also moved in Democrats' favor. But what then does that mean for our portfolio? Well, as we discussed last week, higher volatility variables, the ebb and flow of the virus, the prevalence of point-and-care testing, scientific news on the vaccine, and the success and failure of reopenings will likely continue to dictate market returns in the near term. But no one item appears more volatile than the on-again, off-again negotiations over further fiscal stimulus. The Speaker's bill stands at over $2.2 trillion. Secretary Mnuchin is at $1.6. These are not small numbers, particularly considering the funds would be deployed over just the next 9 months. As an aside, the president's 2017 tax package cost $750 billion for 10 years. The president said he no longer wants to negotiate, and the market didn't like it, but was buoyed by indications that the process between the Speaker and the Secretary continued regardless. Then the president said he would gladly sign a clear bill, that is, legislation that would authorize just one thing, in this case to send out another round of checks, and the market liked that very much. So up and down, we're basically back where we started. We need to look further out. One of the helpful exercises that our team relies on is the Strategas Monthly Economic Diffusion Index. Each month, our chief economist Don Rissmiller and his team classify 14 economic variables as either an asset to economic growth, neutral, or harmful. The difference in the number of positive items and the number of negative results in our diffusion index, which you can see here. The list of indicators is varied: manufacturing, confidence, credit, capex, construction, wages, trade. You get the idea. But as it stands, of the 14, 5 are flashing an improving or supportive signal: interest rates, housing, employment, business confidence, and manufacturing. We view just one, non-residential construction, as a liability. So our index stands at +4, up sharply from the -8 reading we saw in March and February. In short, the economy appears to be gathering steam, and while uneven, is bolstering business confidence. U.S. consumer confidence increased in September too, with the Conference Board survey rising to 101.8. Both the present situation and expectations components improved. And as Don reminds us, with the consumption making up almost 70% of U.S. GDP, this improvement is important and welcomed. Business confidence is also recovering. The Roundtable CEO Index rose 64 in the third quarter. The NFIB's measure of small business confidence also increased. So as society learns to live with the virus, however unpleasant, our renewed confidence at home and in the workplace should feed on itself, and absent another exogenous shock, serve to underpin the durability of the recovery. As we wrap up for this week, I'm reminded of the importance of long-term goals. At Baird, the long-term vision for your portfolio and the plan we build together to get you there is more important than unnecessary concern for every piece of news that hits the wire. That the general trend appears to be improving is at least moderately bullish. But between the abundance of liquidity in the system and the potential that the easiest part of the recovery may be behind us, we remain comfortable, as we mentioned last week, with a gradual rotation towards cyclicals as a durable economic recovery takes shape. Let's leave it there for now, and thank you again for your time. We look forward to seeing you again next week. Please let us know however the Baird team could be helpful, and have a wonderful weekend.